Well, homes are hot, condos are not. Take a trip with us around the Hawaiian Islands. We're going to look at real estate statistics from Oahu, Maui, the Big Island, and Kauai. I'm Patrick ONeill, principal broker owner of Luxury Homes International, coming to you live from our offices in beautiful downtown Honolulu. And I am joined by Hawaii's favorite economist, Mr. Paul Brewbaker. Paul, great to see you again.
Aloha, Patrick.
I'm assuming based on the dress, you are not in Hawaii.
Yeah, I'm spending my winter up in cold country, which today is not that cold, but
Okay,
so
good.
goes the season.
Undisclosed
Yeah,
location.
undisclosed
Um,
location.
Yeah. So some really, really interesting statistics that we're going to look at in a moment regarding real estate. Paul, before we do that, I just wanted to ask you about Hawaii's economy and where you see us
Yeah.
heading this year. Just recently, DBED, Department of Business Economic Development and Tourism, downgraded their growth prediction to 1.7%. And they cited slowing tourism, inflation, and the policy uncertainty that exists out there. What's your take on the macro level brief on the economy of Hawaii, and what should we expect to see this year?
I'm afraid they may still be a little too optimistic. They're not fully taking into account what seems to be now happening with federal fiscal expenditure, the risk coming from the trade wars. But to illustrate what they are talking about and to give you some feel for the magnitude of these things, a 1.7% growth rate, excuse me, would be slightly lower than what they had previously forecast, which I'm showing here in terms of per capita real GDP for Hawaii, the dashed line, and for the US as a whole. You can see Hawaii fell off the rails um, even a little bit before the pandemic, but after the pandemic beatdown, primarily from tourism, was unable to really come back fully from that pandemic, recession-induced recession. And the DBET forecast has been that Hawaii would stay on a parallel track with the US, but of course, parallel is not going back to the national average, and these are in per capita terms. And as you point out in their quarterly forecast update, they've actually revised this downward a little bit. A big part of the reason, it's a big part of Hawaii's economy for Hawaii's failure to keep up with the national recovery and even to get back to its own pre-pandemic performance um, uh, uh, trajectory is seen here in the path of passenger arrivals to Hawaii, uh, uninterrupted during the 20 teens, except for minor things like the volcanic eruption on the Big Island and the seismic event in Japan in 2011, which you can see tend to wash out. But the pandemic was a huge shock from which Hawaii never fully recovered. And then even more recently, the wildfires on Maui have
And
prevented the travel volumes from going back to the pre-pandemic path.
that makes sense. And when you bring up those tourism numbers, as you well know, the Japanese have been such a big part of the luxury tourism market and also the luxury home buying and selling market. And with the weak yen to dollar, I think it's around 150-ish today, they're noticeably absent. Is that part of what's missing there in that drop off in the tourism?
Absolutely. The strong dollar, if you can think of it not just as a weak yen, but a weak Canadian dollar, a relatively weak euro, has impaired the recovery of foreign travel in general to Hawaii. A decade or more ago, 15 years ago, in the recovery from the Great Recession, a strong yen helped recover the Japanese travel volumes that had dropped during that recession. Even when the yen weakened somewhat, partially in the 20 teens, the Jap volume remained relatively steady. These are monthly visitor days, arrivals times length of stay. But after the pandemic, that recovery cut out at about 50% of the pre-pandemic volume because of this dramatic weakness in the yen down to 150, even 160 yen per dollar last summer. I mean, this is the year we should be going to Japan for vacation because it's inexpensive. Hawaii and the U.S. in general, a much more expensive destination for Japanese travelers, but also for um, foreign travelers in general because of the strong dollar.
Yeah. And that's a huge number. It looks like
It's about
half
half,
of,
yeah.
yeah, about half what we experienced before. Do you see anything changing that? Is there anything that would weaken the dollar heading into 2025?
Well, the course of monetary policy as signaled by the Federal Reserve over the next couple of years would have brought US interest rates down somewhat and somewhat relative to the rest of the world, which would have eased the pressure to keep the dollar high. However, because of the tariff wars, foreign governments are going to be inclined to respond perhaps more aggressively. For example, the Canadians already have announced or indicated the likelihood that they would lower their interest rates aggressively, keeping the value of the Canadian dollar low, and as implicitly, and as a consequence, not closing the gap between where longer-term exchange rate equilibrium
I
might be
see.
and where it's been more recently with the stronger U.S. dollar.
So if I summarize that, probably not a big change. They're going to match us if we're coming down in rate as far as currencies go. But who knows? Who knows?
More likely than before because of the trade wars.
Yes. Okay. Well, thank you for that. And that's a good segue. You brought up interest rates. And let's bring in Anders Hostelley, state manager from Rate Mortgage.
Good.
Anders, good to see you. How are you?
Good. How you doing?
Now, you look like you're dressed like you are in Hawaii. I don't think you're in Colorado.
Or at least I got my rate shirt on here.
Yes, you do. Okay. Um, well, I mean, rates have been on such a wild ride, over the past year. It's just been crazy. Last time we spoke, which I think was in January, rates were back up around 7%. I think you have some good news for us. And of course, we're talking about a 30-year vanilla rate, vanilla borrower. Where is the 30-year rate today?
Yeah, we were talking in January, almost getting up to that close to 7% again. So today I can almost say that they're in the low sixes right now. So we've
Wow.
seen at least like a 0.5% in rate that has dropped down. So that's really helped out. Also, ARM adjustable rate mortgages, we're seeing them even drop a little bit farther down. So you can get a 5-year, fixed for 5 years adjustable rate mortgage in the kind of high fives right
So I'm
now.
gonna I'm gonna bring up the chart from Freddie Mac, and it kind of shows the trajectory that we've been on. Now, the
Okay.
rate that they're showing on their website is 6.63, and you're saying right now probably in the low sixes. Does that include a point or something? Is that how you
Yeah,
get to
they
that
include the
calculation?
point, and this survey is from it's from last week. So we, you tune this. There's always a little bit of a lag from this survey, but I mean, this is a weekly survey. But yeah, it's things have definitely improved as
Oh,
far as
that
interest rates go. Yeah.
that is really good to hear. What about so we're talking about conventional loans. What about on VA, FHA loans? What are you seeing there?
The government loans or government-backed loans, especially VA, we're seeing they're in the fives.
Wow.
It's high fives.
Yeah.
But yeah,
High five.
yeah, high five. So boom, they definitely improved as well. So no, it's a good signal. And then we're seeing a little bit more refinance activity
Oh,
that we
okay.
have, especially in the later half of last year. You didn't see much of that, except for their September. There was like a little blip, rates had come down, but then they
So
went.
I'm curious about this because everybody's sort of been waiting for this moment to refi if they locked
Mhm,
in something at 7 or above, which rates
mhm,
were close to 8 at one point.
right.
Um, is there a general rule of thumb if I'm a homeowner and I'm thinking about refinancing? Do you say, hey, if you're here and it drops to here, this is the moment to start thinking about it? So is there anything like that?
Yeah. So what we do is we kind of do a break even analysis. We'll look at what the closing costs are. Let's say if you can break even, the monthly savings divided by the cost. And if that's within 2 to 3 years, then you know what, and if you're going to stay in the home for longer than that, it's worth
Hmm.
doing a refinance. But refinancing also depends on the loan amount. The larger the loan amount, the less of an interest rate drop you really need to make it beneficial to refinance. All right,
Oh, I
because
see.
when you look at your monthly payment, there's more of a significant decrease when the rate,
Okay.
the loan is larger.
if I was at a 7.5 and rates are now 6.3, is
Mhm.
that typically that's probably going to make sense based on
It's
all the other
yeah,
criteria? Okay.
based on
All
the
right.
criteria, definitely. Yeah.
You mentioned the adjustable rate mortgages. Where are those rates, and is that becoming more popular as an alternative?
Yeah, definitely. We're seeing a little more activity on adjustable rate mortgages. So in a 5 year, which is fixed for the 5 year first 5 years, it's in the mid high five percent range. And then you can get a arm that's fixed for 7 years. It's a little bit higher than that. And there's even an arm for 10 years, fixed for the first 10 years. I mean,
I
the
see.
average that someone has a mortgage is about 6 or 7 years. So, I mean, oftentimes when you look at it, maybe just doing an arm, saving money over the years you're going to be in the property is
Yeah.
a it's a good alternative. It's a good
Huh.
option.
Makes sense. Are you seeing more people take that or other creative type of financing structures?
Well, what we're seeing more of is what we call non-QM loans. Loans that are made to, or I mean, it could be made to an investor that we only look at the cash flow on the property.
Hmm.
That's something that's become very popular in the last 2, 3 years. We have more investors that are looking at or are able to do or finance condominiums that have some what we call non-warrantable features that
Yeah.
don't fit in the Fannie Mae or Freddie Mac box.
Right.
We are starting to do some interest-only loans that
Mm.
we hadn't seen in the past, like maybe a 40 year, it's interest only, and then after the first 10 years, it becomes a principal and interest payment.
Sounds
But
like the good old days.
it it does, but you still got to, in a way, qualify.
Yeah.
Yeah, I
Yeah.
remember
Yeah. I got you.
100%
And
loans, interest only, and you didn't even have to qualify. So anyway, that was a long time ago, but yeah,
yes. Okay. And then I know you look at implications and rate locks to have a gauge on the market. Are you seeing any change, uptick, downtick?
it's been pretty steady the last 2, 3 weeks, or let's say in the last month, the
Okay.
activity.
Okay.
So yeah, but I do feel like interest rates where they're at, people have become more accepting or buyers of where they're at right now, interest rates,
Okay.
and the kind of prospect of them going down a little bit. Yeah.
Okay. I know this is an impossible question, but it's always fun to ask you
I
because we haven't been
want
around
to
for
get it right one
years.
day. Yeah.
Yeah, so this might be the day. February 2026, where do you suspect the 30-year rate would be?
Yeah, I think we'll be in the high fives. I think we're going to be, right now we're in the low sixes. I think we could see like in the high fives. Yeah,
Okay.
maybe the mid fives, but I'll stick with the high fives now.
All right. All right, Anders. Well, thank you. Thanks for taking the time to share all that with us today. It's always great to hear
Of course.
exactly what's
Yeah.
going on. Yeah. So for everybody else, stand by. We'll be right back with economist Paul Brubaker. We're going to take a trip around the islands and look at the real estate markets. We'll be right back. Okay, and we're back with economist Paul Brubaker. Time to take a little trip. We're going to head over to Maui, the Big Island, and Kauai, see what's happening on the price trends there. Paul, why don't we start with the Valley Isle of Maui? What do you see
Sure.
in the trends right now?
So, a couple of basic themes. The neighbor islands are very much like each other in terms of home prices, generally speaking, very much like Oahu. The prices you would recognize on Oahu as well as on Maui, on Kauai, on the Kona side of the Big Island, not the Hilo side. And that makes Big Island problematic because when you smush them together, they turn out, the average is like half the price of Kauai or Maui or Oahu. Kona is essentially Kauai, Maui, and Oahu, but Hilo is a big affordable
Hilo's
market.
Hilo.
Hilo suck. Okay, second important thing. Condos on Oahu are mostly in the urban core. They are urban dwellings for the affordable, um, working class kind of market segment. Single family homes are more suburban, etc. On the neighbor islands, condos are in the resort areas. They're not in the center of Kahului, Wailuku, like they are in the
Yes.
center of Mo'iliili or, whatever. And because they're in resort areas, they tend to be more expensive. So they're much more investor driven. You buy larger proportions of buyers, maybe 40%, are offshore buyers in the neighbor island markets versus 10 or 15% on Oahu. So two big distinctions. Home prices tend to look very much as they do on Oahu, except for Hilo. And condos on Oahu are in the urban core, but on the neighbor islands are mostly in resort areas. And let's face it, most of us don't live in resort areas because they're too expensive. So
Right.
let's take a look at what's really important if you're thinking about a notion of economic equilibrium, which is the path, the trajectory. Equilibrium has to do with the rate of appreciation. And here you're looking at Maui data for both single family and condo prices, where the dynamics are very the same, the bubblicious movement in the subprime cycle of the early 2000s, the long, steady appreciation trajectory, 4.5, 5.5% appreciation over time, and then the post-pandemic surge, partly associated with the changing structure of the workforce and remote work, but also some persistence above trend that raises some questions about whether those prices will settle, whether the trajectory has been displaced by remote work, and a stronger showing in the condo market than we'll see later when we look at Oahu, because again, the condos on Maui and elsewhere on the neighbor islands tend to
And
be
Paul, I
more
just want
resort
to add,
oriented.
looking at this right now, and you just touched on it. Can you go back to that slide? So this
Yeah,
is Maui home prices, condo prices. They're
yeah,
right on trend. They stayed together, through the whole pandemic. And
yeah,
it is going to look so dramatically different when we get to condos on Oahu. And that really goes to what you just said. Condos neighbor island
absolutely.
is generally resort, second home investor. Very interesting to see this when we see it in comparison. Okay,
Yeah.
please. Yeah.
Let's
And
continue by looking across the neighbor islands. Now, it
okay.
just gets a little more complicated without helping to keep throwing the condos in. So I'm just going to look at single family homes. Again, I'm leaving condos out because they're resort properties. By and large, they're resort properties. They tend to move much more as an investment vehicle as opposed to a residential. They're all investments, but they tend to have other characteristics. For example, they're caught up in the political controversies over short-term rentals that complicate interpretation. But here are those same Maui single-family prices, but now I've actually introduced Kauai single family prices, as well as all of the Big Island. So Big Island's
Hmm.
on the right scale, which is half the price of the left scale. Again, the equilibrium is a path that, in this case, I've estimated a long-term path between 5.5% and 6%. And whether it's Maui or Hawaii single family or Big Island right scale on average, half of which is Kona, which looks exactly like Kauai and Maui, or all three together, you can see that they
Wow.
tend to move on the same trajectory, they have the same cycles, and indeed, we can see these data. You haven't seen these data, but we can see these data in Federal Housing Finance Administration compilations, not just of sales prices, but the collateral valuations that Anders and mortgage lenders are using. So this is basically every house that gets funding, gets mortgage financing, plus the sales prices are put together in these indices. I've removed the inflation from these time series, again, to illustrate the long-term convergent trend, these cycles above and coming back to trend, and the fact that after inflation, housing has had a solid 2% annualized return. That's 2% in real terms, and you can stick the inflation on top of that to get to get your nominal return. So,
Yes.
you know,
Well,
we're above
fascinating
trend.
how,
We're
yes,
Yeah.
fascinating how closely the neighbor islands all tracking. Maui, Big Island, Kauai, when you show those single family home numbers.
You do have to remember that the reason why these paths they deviate from time to time for sure. And they deviate, from state to state. If we looked at Phoenix, it would actually look remarkably different from Iowa or Hawaii. But in a place like Hawaii, where each of the four counties, each of the major islands is much more similar than different, capital mobility and arbitrage, these financial market forces are going to push the equilibrium rate of return towards a common trajectory.
Yeah. Oh, interesting. Really, really enjoyed seeing that. And now to see total contrast in some ways, we're going to take a look at the Oahu numbers and especially the condo market. Some of it is shocking. Even when I looked at it, I was like, wow, is this right? I had to do the calculation a few times. So we're going to take a real quick break and then be right back with economist Paul Brewbaker, take a look at the numbers on Oahu. So stand by.
Okie doke.
Welcome back to the Hawaii Housing Report with economist Paul Brewbaker. I'm Patrick ONeill, Luxury Homes International. So glad to have you along. All right, Paul, let's come back to the gathering place, Oahu, and take a look at some of the statistics that we have here. And these are all furnished by the Honolulu Board of Realtors, the latest statistics just published. Let's start with active inventory, the number of units for sale. And this, to me, is one of the most interesting statistics that I've seen. Okay, we start with single family homes, and we're looking at February, month of February. Single family homes compared to last year up 12%, up 27% compared to 2023. And then I wanted to go pre-pandemic 2019, which was actually towards the tail end of the last cycle when things were just starting to come down. But if you look at active inventory, we're still missing half the inventory we had in 2019. And a lot of this is that mortgage rate handcuff. You know, the right is that the prison, the 3% prison, as they call it, the homeowners who are locked in.
Stuck trapped in your house with a 3% mortgage. Boo.
Yeah, that sounds pretty good, doesn't it? Okay, now here's where it gets a little wild and a little crazy. Let's look at condos now. Condos as of February, over 2,000 condos for sale. Now, compared to 2019, it's only down 8%. That was pretty interesting to me to see that we're back where we were 2019 as far as inventory is concerned. And now this is where it gets nuts. Compared to last year, there are 56% more condos on the market for sale. But wait, there's more. Compared to 2023, it's nearly double, 85%. And I know you said part of this is the short-term rental disclosure issue. And then certainly we've covered it before, but it's the vintage problem with the capital X improvements needed in the buildings. It certainly is the insurance problem, which isn't going away anytime soon. And then the Honolulu, the fire safety systems, which also need to be installed shortly, or we'll see what happens with that. But it's really been a bloodbath on the condos.
Yeah.
Anything you wanted to add there on this active inventory?
I mean, the whole segment's stigmatized, and as you say, for a variety of reasons, some of them out of our control because, the climate is changing or whatever is causing storms to be more intense and more costly, causing insurance to be more costly as a consequence, or these political changes where investors thought they, had an opportunity to make some money in short-term rental use of their
Yeah.
property, and turns out maybe they won't.
Yeah, yeah, it's going to have a big impact, or it is having a big impact. Okay, let's look at annual closed sales. Not sorry, not annual. This is year to date February closed sales. When we look at homes, this is year to date number compared to last February. It's only 2 months of data, but is unchanged. It's actually the same number compared to 2023, up 12%. Compared to 2019, down 20%, which kind of surprised me that we're doing 80% of the volume on single family homes that we were selling in 2019. And then we get to condos. So condos are down slightly from last year, basically flat compared to 2023, and then down 6.5. Nothing too dramatic here. Does anything stick out to you about the closed sales data?
No, it's just the last few years, we have seen mortgage rates go from way down around 3% to way up around 7%. So there's a little bit of whiplash that's hidden in these statistics, I'm afraid.
Yes. Okay. All right. And now this is my favorite figure when I look at the statistics. Months of remaining inventory. This accounts for how many units are for sale and at what pace are they selling for. And we've generally talked about market equilibrium around 4.5 months of remaining
Okay.
inventory.
Yeah.
Anything higher than that is going to be considered a buyer's market. Anything lower than that would be considered a seller's market. When we look at the figures for February, 3.1 single family home, that's clearly in the zone of a seller's market. 5.8, nearly 6 months remaining inventory for condos, clearly a buyer's market. And I've done a little chart to kind of demonstrate this in another way, which is you can see the equilibrium, which is the dotted red line. That's what we think equilibrium, around 4.5%. Above that, buyer's market; below, seller's market. Do you see anything that's going to change this in the short term?
No, and again, this really has to do with the stigma we talked about that currently is attached to some condominiums, not all condominiums, but it's a problem for the segment as a whole for a variety of reasons. The contrast I would point out is that prior to the controversies about short-term rentals, and I highlight here, same data as yours, you had February for each of the last 5 years, which is important because seasonal patterns vary. So if you use February every year, you're comparing like seasons across different years. I've adjusted for all the seasonality, and you can see ever since here's the City Council's Bill 19 or the legislature's Senate Bill 2919 in last year's legislature, these tourism or short-term rental regulatory political controversies have tended to adversely impact the condominium inventory numbers. And prior to those political controversies, prior to 2019, these inventory numbers moved very close together. We've got 20, 25 years of data where it used to be they always moved together. So this is what's happening right now is really something specific to condos. And as we've talked about, multiple factors, but the political factor is an important source of uncertainty and therefore investor reluctance that's causing the switch over, as you say, to more of a seller's. What is it? Am I
Yeah,
getting it
seller's
backwards? It's
market.
seller's
Yeah,
market than a buyer
seller's
market.
market in the single family, buyer's market in the condo.
The irony being is that the pileup is because the sellers aren't able to sell.
Yeah,
Is that
all
what I'm
kinds of.
trying? Is that what we're saying? Did,
Well,
did I,
limited supply in
yeah,
the single family home, which has been
in the
driving
single
that
family
market.
market, but
Yeah,
yes,
including
excess.
pricing, which we're going to look at next. So part
Sure.
of this supply and demand imbalance, certainly in the single family, has driven prices up. What has it done to condos? I'm sure we can figure that one out. So let's switch over and take a look at the pricing.
Okay.
Okay, and looking at the annual median price on Oahu. And by the way, the data we're going to look at is year to date, but the February number alone set a new record high for single family homes at 1,185,000. Paul, does that signify anything that a monthly number hits a new record?
Well, of course, if everything were just on an escalator at say 5% per year, every month would be a record. But
Oh,
not
okay.
really. I mean,
Okay. All right. All right. Okay. Wanted to ask. All right. If we look at year-to-date pricing compared to 2024, the statistics show a 9% increase, that's pretty healthy. And I know we're going to look at long-term trend in just a moment.
yeah,
Compared to 2023, nearly 20%. I mean, that's pretty cool. I mean, it's tracking right in that 9%,
yeah, that's
8%
like
per year.
eight 8% per year plus compounding or something like that.
Yeah. Now we look at condos, 513,000 and change, basically flat compared to last year in
Mm.
the pricing statistic. Compared to 2023, up 6%. I mean, I guess you could say 3% price growth over the last 2 years. What does it look like when we look at the long-term trend line on the pricing in these two segments?
Remember that we're stuck in this little bit of a hellhole with high mortgage interest rates and low home sales. So we're not seeing, we're seeing a lot of people holding back because they're locked into 3% mortgages, and it's a little early for them to come out and shake up the market. This is true, by the way, both on Oahu as well as on the neighbor islands, which we were talking about earlier. But in terms of the Oahu median prices that you were just showing, again, a real dichotomy that we saw in the inventory data also presenting itself in these prices, where the single family homes benefited from the increase in remote work after the onset of pandemic, and then the durability of remote work as a new form of workforce and workplace participation, with prices continuing to rise at about the rate they had historically. Whereas on the condo side, as you saw, maybe flat to a year ago, or maybe up slightly from a couple of years ago, a bit more of condo price meandering through the wilderness and meandering a little bit below the longer term trend. We were looking at 3% compounded over 2 years instead of the 5% that was the historic performance in the 20 teens.
Yes.
Again, I don't know how this is going to resolve itself, right? One way of thinking about it is that condos just keep getting to be a better deal on Oahu relative to single family homes. And for, a lot of the buyers about which we have social and socioeconomic and political concerns, the affordable home buyer that's kind of locked out. I mean, it's all relative. You see what I mean? So,
Yes.
they're
Yeah.
two sides of the same coin. There's something going on that is creating a distinction between these market segments that eventually one would imagine will resolve itself to return them to a common path.
Yeah. Okay, great. Well, Paul, looking into the future, looking into your crystal ball, um, as you look at home prices, where do you see that a year from now, February of next year, on a percentage basis? And where would you see condo prices on a percentage basis?
I think pending the resolution of the short-term rental political upheaval, this is playing out more aggressively on the neighbor islands right now than on Oahu. We should see a restoration of this these longer term trends. Um, I would point out, and I think I have one more slide here somewhere. If you look at sales volumes in the much longer sweep of history, relatively speaking, we're in kind of a quiet period for the housing market. And so, in addition to maybe some resolution of the political controversies, maybe some settling down of the upheaval in insurance and maintenance costs issues, as well as a move towards a more normal interest rate environment over the next couple of years. I think we move into into a resolution period in the late 2020, mid to late. We're in the mid 2020s now, moving through the late 2020s. We sort of get things realigned and back on track, get a little bit more participation in the marketplace, and maybe with any luck, if the regulatory response is adequate, maybe getting some more building that we should probably have been seeing all along.
Yeah, that would be great. Well, Paul, unfortunately, we've run out of time. I have so many more questions I want to ask you, but thank you very much for making the time. Look forward to next month. And to everyone watching, if you've enjoyed this information, please hit the thumbs up down below and make sure you subscribe so you don't miss next month's Hawaii Housing Report. So until next time, be well, be kind, and aloha.